Good afternoon, students. While continuing the chapter number 5, that is ratio analysis, let's start the part B, ratio, that is solvency ratio. Solvency ratio consists of various type of ratio that we discussed earlier. Let's start turn by turn. First of all, let's discuss debt equity ratio. Solvency ratio, the meaning has been discussed in the previous video, that the ratio which shows the solvency of the position of a business enterprises is known as solvency ratio. Solvency means that how much the business is capable and strong to pay its borrowing. If any company or any business enterprises has sufficient funds or has a satisfactory financial position to pay its debt, then the firm is considered solvent. If it is not do so, then it is considered insolvent. Solvency ratio expresses as that what is the capacity of a business enterprises to pay its debt, in which we will do the debt equity ratio first of all. What is debt equity ratio? It is a ratio express the relationship between the long-term debt and shareholder funds. It indicates the proportion of the funds which are acquired by the long-term borrowing in comparison to the shareholder funds. If I discuss the formula, then it is clear to you. Debt equity ratio. See, debt equity ratio. The formula is hidden in the name of the ratio. Debt upon equity. Debt upon equity. Here, debt means the long-term. Debts means the long-term borrowings and all. Equity means the shareholder funds, or we can say the net worth. So debt are the long-term debts, while the equity is the shareholder. Let's see what are the items consist of long-term debts. It includes all the long-term borrowing, all the long-term provisions which mature after 1 year. Long-term means which is to be done after 1 year, which are within 1 year, that are current liabilities. For example, debentures are there, mortgage loan are there, bank loan, loan from financial institution, and public debt. If I talk about the shareholder fund, it consists of share capital, which can be of equity share as well as preference share capital, reserve and surplus. The reserve and surplus include all type of reserve, like capital reserve is there, general reserve is there, security premiums are there, and balance and statement on profit and loss. So you have to draft a formula in which you have to draw the long-term debts consist of all these items, that are your long-term borrowings, that are your long-term provisions, that are your debentures, mortgage loan, bank loan, loan from the financial institution, public deposit. And while calculating the shareholder fund, you have to add any equity share capital if there, preference share capital, capital reserve, security premium, general reserve, balance and statement of profit and loss. In this way, you can calculate the value of debt and equity very easily. If I talk about the solvency position as per the ideal ratio of debt equity, it should be at least 2:1. If the company has a 2:1 debt equity ratio, then it is considered that the company has a good position. So let's do the practical illustration 26. Then it will be more clear how to calculate debt equity ratio. Here capital is given to us, reserve and surplus, long-term borrowing, provisions, current liabilities, non-current assets and current assets are given to us. What conclusion do you draw about the company on the basis of this ratio? Here the debt are to be calculated. Debt means the long-term debt. It consists of all the long-term borrowing as well as long-term provisions. So long-term borrowings and are 1,20,000, that is given in the statement, while the provisions are 50,000, that is also given in the statement. It is of 1,70,000 in total. When we calculate the net worth, or we can say the shareholder fund, then it is calculated. If from the liability side we are calculating the net worth, it will be share capital plus reserve and surplus. Alternatively, you can calculate with the help of assets as well. If the assets are there, then the non-current assets and working capital minus non-current liability, we can say, is also our shareholder. Whatever the information is given to you, you have to apply the formula accordingly. But don't forget to write all these formulas all together for avoiding the confusion. Now the debt equity ratio, after calculating the debt and equity, is to be put in the formula and we will get the ratio 0.47 ratio 1. So this ratio indicates the extent of the funds provided by the long-term lenders in comparison to the funds provided by the owner, that is your shareholder. The normally acceptable debt equity ratio is 2:1. If the higher the ratio than 2:1, it means the long-term borrowing are more than twice in comparison to the funds provided by the owner. And it will indicate a risky financial position. In this question, long-term loans are only 0.47 in comparison to shareholder fund. It shows that the long-term financial position of a company is sound. So in this way, you can calculate the debt equity ratio. The another question is also related to this. You have to apply the formula and do it. Let's go for the next ratio that is to be done. You have to attempt all these questions yourself because I have discussed the formula. If you find any difficulty, please ask. If you find any of the confusion in any formula, but you have to derive the formula yourself. Once if you clarify the concept, then it will become very easy for you to identify the debt as well as equity, and then you can calculate the debt equity ratio. Let's go for the second ratio now, total asset to debt ratio. This ratio is a variation of the debt equity ratio and gives the same indication as the debt equity ratio. In this ratio, total assets are expressed in relation to long-term debt. It is calculated as under. Here the total assets are to the debt ratio means the formula is hidden in the name of the ratio. It is total assets upon debt. If we divide the total asset upon debt, we will get the total asset to debt ratio. This ratio is also known as pure ratio. Please mark it because from one mark point of view, you may get the question in the exam. That what is the pure ratio? The total asset to debt ratio is also known as pure ratio. And what is it? It may be the 1:1 or 2:1. How the total assets are to be calculated? All the assets when combined all together, the sum total of all the assets will be considered as the total assets. Here the total assets are all the non-current assets, whether these are tangible or intangible, not hardly matters. All the assets include in non-current assets. All the non-current investments are there, long-term loans and advances, plus all the current assets as well. If we add all type of assets, whether it is tangible or intangible, then we will get the assets. Now the debt, we already discussed. All the long-term borrowing as well as long-term provision consist of debt. After calculating the debt and total asset, we can apply it in the formula and calculate the total asset to debt ratio. Let's see example number 33, then it will be more clear to us. Here are the fixed assets, non-current investments, current assets, total debts, trade payable, outstanding expense, bank overdraft is given. Now how to calculate? We have to write the formula first of all. Our formula is total asset to debt ratio. Now, total assets are all the fixed assets, current investments and current assets. By adding and getting the sum of all these items, we will get our total assets value, that is 25 lakh 60. Now, if I talk about the long-term debts, long-term debts are to be calculated total debts minus trade payable minus outstanding expense minus bank overdraft, because we have to calculate the long-term debt. So, if any short-term debt means the current liabilities consist or included in the total debts, which is to be deducted first of all. In the question, total debts are given to us as well as some current liabilities are given to us. If we deduct the current liabilities out of the total debts, we will get the short-term debts or long-term debts, because current liabilities are the short-term debts kind of. In this way, we will get the net value of long-term debt, that is 16 lakh. Now, total asset to debt ratio will be total assets upon debt is 1.6 ratio. In this way, you will get the various illustration in which the formula you find change clues related to the total debts and assets are just given to differently in every question, but the basic formula is absolutely same. So you have to do all these questions. If you find any difficulty, please feel free to have the queries anytime. After that, the consolidated question is given to you, in which you have to calculate the total asset to debt ratio, proprietary ratio, as well as debt equity ratio. Let's see what is proprietary ratio. Right now, the proprietary ratio formula is floating on the screen. Earlier to this, we have done two type of ratios under the solvency. One is debt equity ratio, another is total asset to debt ratio. Now, proprietary ratio. Proprietary means that is related to proprietor. Proprietor means are the owners. Owners are the shareholders who holding the proprietor's fund. So equity is also known as the proprietor's fund as well as the shareholder fund. So equity upon total assets is known as the proprietary ratio. And proprietary funds of the share or the shareholder fund, we can say it is the equity. And total assets, as we discussed earlier, all the non-current assets as well as current assets all together combined and get us the total assets. So proprietary ratio is to be calculated. Equity, you know how to calculate. Total asset, you know how to calculate. By putting the values in the formula, you may get the proprietary ratio. Let's see illustration number 38. The next will be more clear to you. Here the equity share capital, preference share capital, journal reserve, profit and loss balance, debentures, trade payable, outstanding expense are given to us. We have to draw the conclusion as well as all these three ratios. Debt equity ratio, debt upon equity. Here the long-term debt are only the one item is given, that is your 8% debenture. Nothing else is there related to long-term debt. So these 3 lakh rupees are considered as debt in this question. If I talk about the shareholder fund, it will be equity share capital, preference share capital, journal reserve, and profit and loss balance. By putting the values in the formula, we will get the value of the ratio, that is 0.43 ratio 1. It will be 0.43 ratio 1 by dividing the 3 lakh by 7 lakh. Now you have to comment or give the conclusion. This ratios, if the company has the ratio more than 2:1, the debt equity ratio of above company is 0.43 ratio 1. It indicates the long-term debt are only 0.43 in comparison to the shareholder fund. Hence, it may be considered that the long-term financial position of the company is very sound. If I talk about the total asset to debt ratio, it will be total assets upon debt. Total assets, you know how to calculate from the liability side. If you calculate the total asset, all the side of the total assets is equal to liabilities, equity and liability. The total of the equity and liability side is also known as the total. As the information related to equity and liability is given to us, so we have to consider this formula. Equity share capital, preference share capital, journal reserve, profit and loss balance, 8% debenture, trade payable, outstanding expense. All these items get a total of rupees 12 lakh that will be considered as the asset. Then total asset to debt ratio, debt already we calculated in the above ratio, that is 3 lakh. These are our long-term debt. By putting the ratio, we will get 4 ratio 1. It means the total assets of the company are 4 times in comparison to the long-term debt, which shows that use of lower debt in financing the asset, which means higher securities to the lender. Next one is the proprietary ratio. Equity upon total assets. We have calculated the equity here. and you have calculated the total assets as well. By putting the values in the formula, you will get the proprietary ratio. Then the shareholder fund of the company are 58.33%. It may be given in the percentage or the ratio as well. In other words, 58.33% of the total asset of the company are funded by the equity, which indicates that the long-term financial position of the company is very sound. So in this way, you have to attempt the question, or the next question are the consolidated one, in which you have to calculate all these three ratios with the help of wealth. The next and the last solvency ratio is the interest coverage ratio. This ratio is also termed as debt service ratio. Don't forget to learn both of the names, that is your ICR, interest coverage ratio, and debt service ratio. It is to be calculated by dividing the profit before. Don't forget the formula, profit before charging interest and income tax by fixed interest charge. And this ratio is not to be calculated in proportion, this is calculated in times. Whatever the answer you will get, it will be in times. Now the question arises, how the profit before charging interest and income tax. The profit before interest and income tax is to be taken for the calculation of this ratio, because this amount of profit out of which interest and income tax is to be paid out. And fixed interest charges include interest on fixed, the long-term loans or debentures. What is the objective of calculating this ratio? This ratio indicates that how many times the interest charges are covered by profit available to pay the interest charges. A long-term lender is interested in finding out whether the business will earn sufficient profits to pay the interest regularly. This ratio measures the margin of the safety of the long-term lenders as well. The higher the ratio, more secure the lender is in respect of payment of interest regularly. If profits are just equal to interest, it is an unsafe position for the lender as well as for the company, as nothing will be left for the shareholder. So it is all about the interest coverage ratio. Let's see with the help of the upcoming example that how the ratio is to be calculated. See, from the following details obtained from the financial statements of KX Limited for the year ended 31st March 2017, calculate interest coverage ratio. Here the profit is given net profit after tax, but what we required the net profit before interest and tax. Here the 40 lakh rupees of debentures, 12% debenture of 100 each is given to us, and the tax rate is 40%. State the significance also. Will the interest coverage ratio change if during the year 2017-18 company decided to redeem the debenture of 5 lakh and expects to maintain the same of net profit and assume that the tax rate will not change? Let's calculate the interest coverage ratio first of all. In this question, we know very well the profit after tax is given to us. Actually, the profit after tax is with us. We can consider, let it be the profit after tax, profit before tax is 100 and rate of tax is 40%. So 100 minus 40, we will get the profit after tax, that is 60. Now we can put the statement, if the profit after tax is 60, then the profit before tax must be 100. If the profit after tax is 1, then it will be 100 upon 60. And if the profit before after tax is 6 lakh, then profit before tax must be 100 upon 60 into 6 lakh, that will be 10 lakh rupees. Now we have to add interest here. How the interest is to be added? Don't forget, interest is to be calculated on the face value of the debenture. The debentures are of rupees 40 lakh. 12% interest is to be provided on the debenture. So 12% of 40 lakh will be 4 lakh 80,000. So net profit after interest and tax will be left with us, that is 14 lakh 80,000. Now the interest coverage ratio will be 14 lakh 80,000 divided by 4 lakh 80,000. It will be 3.08 times. The calculation of profit before interest and tax matters. That's why I'm repeating. The actual profit after tax is given to us, and ratio of tax is also given to us. With the help of this ratio of tax and the net profit after tax, that is 60,000, apply the statement and we can calculate the profit before tax. The profit after tax is 60. The profit before tax must be 100. If the profit after tax is 6 lakh, then profit before tax must be 100 upon 6, multiplied by 6 lakh. In this way, we can calculate the profit before tax. After calculating the profit before tax, the interest is to be added to that and we will get the net profit before interest and tax. And then interest coverage ratio is to be calculated by putting net profit before tax upon the fixed interest charge, that is 4 lakh 80. So in this way, we have to calculate the interest coverage ratio. Now, if we have to comment, then normally acceptable, the interest coverage ratio is 6 or 7 times, whereas the actual ratio for the company is 0.08. It means the profit of this company are 3.08 times in comparison to the fixed interest charges. This indicates that the firm will not be able to pay the interest on long-term loans regularly. This ratio also indicates that the long-term solvency position of the company is not satisfactory. In this way, it is all about the ratios that we done. Right? Let's recall what we have done. We have done the solvency ratio, which shows the solvency position of a business, that how much business is capable to pay its debt, in which first of all we have done the debt equity ratio, that is debt upon equity. Second, we have done total asset to debt ratio, and which is to be calculated by the formula total assets upon debt. Next, we have done the proprietary ratio, which you have to consider the formula that how the proprietary ratio is to be calculated. The formula of calculation of proprietary ratio is equity upon total assets. And the fourth one we have done interest coverage ratio. And interest coverage ratio is to be calculated by putting the formula profit before interest and income tax upon fixed interest charge. All the above three ratios are interrelated with each other. If you are able to calculate debt, total assets, and equity, you can put all those values in the respective formula and you can calculate the value in proportion. Mind it, the interest coverage ratio formula is quite different from all those three. In this, we required profit before interest and income tax, and whatever the fixed interest is charges by the company, it is also. And this ratio is shown in time. This is all about for the day that we have discussed. Now I request sir to unmute allow the students to have their queries.